Okay, great. So we'll start today's webinar now. So thanks for tuning in to today's webinar. So for today, we'll be covering mainly on the US equity market. And title for this particular piece would be All Clear for Now. So to give you guys a brief overview of what we'll be covering today, we'll be talking a lot on where we are in terms of the economical cycle. More specifically, we are right now in a late stage economical cycle and how this will actually pan out in the near future. And then subsequently also looking into some major indicators to sort of spot possible market tops coming in the near future. So yeah, without further ado, let's get straight into today's webinar. So the main piece for today webinar will be revolving around economical cycle. So on your screen, you can see what this US economical cycle is telling us is that we are right now in the late stage economical cycle. And what I mean by that is right now we are in the third longest economic expansion in history at 98 months. So the table here tabulates the economical expansion as well as economical contraction all the way back from 1933. And how we define economic expansion is basically Q on Q GDP growth, whereas economic contraction basically is being defined by negative Q on Q GDP growth. So you can see historically, on average, the economic expansion is about 60 months. And right now we are way above this particular threshold of 60 months. And the current economic expansion happened back in June of 2009. And right now we are in the 98 months of the economic expansion. Some things to take note over here is the previous two times we actually surpassed this level of 98 months and above economic expansion. It was during the 1960 decade, whereby we saw 107 months of expansion, and the longest of all economic expansion happened in the 1990s decade at 190 months. Something worth noting also is the current economic expansion has way surpassed what we have seen during the housing boom period of 2000, whereby GFC happened and the particular cycle lasted for 73 months. So right now we are way above the 2000 housing boom economic expansion period of 73 months. And we believe just from this economic expansion and contraction table, we can see that we are definitely nearing the end of this economic expansion rather than at the beginning phases of this economic expansion. So how do we actually play out in the near future? We'll discuss again with some help of the indicator to sort of pinpoint where the market might head to in the near future. But before even going there, we'd like to supplement the idea of how we are actually nearing the end stage of this economical cycle, whereby the expansion might actually be heading into a contraction convert period. So what we notice is we realize a few of the indicators that we follow, more so in the volatility index in equity as well as treasury, as well as a few sentiment indicators and unemployment claims and unemployment rates are showing a similar late stage economic cycle whereby all of those indicators are taking out pre-crisis high level, more so the GFC peak. So I will show you guys more in the following charts what I mean by that. But before we get to that, just like to show some property that is being sort of displayed by these indicators. So we found out that the indicators I just mentioned do actually move in a certain kind of a sine wave pattern as seen on this screen over here. So whenever they enter into both extreme, either the upper extreme side of things or the lower extreme side of things, usually when we are nearing that area, it's telling us that we are reaching the late stage economic cycle and a mean reversion tends to happen. So depending on what indicators we are looking at, some of it at the upper extreme tells us that we are at the late stage economic cycle, whereas certain other indicators are on the opposite side, whereby it's hovering at the lower extreme side of things. So to be a little bit clearer what I mean by that. So here we have the equity VIX showing that we are right now reaching a late stage economic cycle. As you can see over here, this is the S&P 500 volatility index. So we actually drew out two boundaries over here. The lower extreme over here points to around 9.39. Anything below this level shows extreme complacency. And like I showed in the previous chart, whenever we hit extremes on both sides. So for this case, for equity VIX, we are talking about the lower extreme. When that is actually reached, it's actually telling us that we are reaching the end stage of this particular expansionary cycle. So what I mean by that is you can see GFC low was at 9.39, and since then mean reversion between the VIX actually happened, pretty sharply. Thing to take note over here is during the dot-com period, you can see even the lower extreme side of things during the dot-com was at a higher level at 16.28. And we are talking about a period of 1998 all the way to 2002, whereby the low didn't really breach below this 16.28 level. So the outlook for the equity VIX, we believe that the 8.84 low that we have seen back in June probably might be this particular cyclical low, and a mean reversion within this VIX space might actually take place to bring the VIX back up to a more normalized range to sort of scrape out the extreme complacency that we have been witnessing. To make matters worse, looking at the non-commercial short contracts VIX futures. So this is a report that's been tabulated by the Commitments of Trader by the CFTC. So what non-commercials are, they are basically your hedge funds, your big boys, making speculative bets. And more so for this particular case, we are talking about short contracts within the VIX future space. So why I actually pointed this chart out is because you can see during the GFC period, the short contracts for the VIX futures was only hovering around a high of 26,000 back then. And since that whole period, starting 2010, 2011 each period, the amount of short contracts that have been coming to the market hit an unprecedented high. And for the whole period of 2012 to 2015, we're actually hovering around 200,000 upper threshold, whereby short squeezes tend to happen at the same time spiking the VIX. So something changed again in 2016 last year. So there was a paradigm shift whereby the VIX short contracts actually breached through this 200,000 upper threshold, and it reached out to a new level of 290,000 to be a new upper threshold. So what we are seeing here is same thing over here. We are right now entering the period, a level whereby short squeeze are having a tendency to happen. So we believe that this amount of short contracts that is building up the market is also showing extreme greed and complacency. A recent high of 350,000 unprecedented high, sort of signaling that the VIX itself is a ticking time bomb, whereby any short squeeze within the complex over here should cause the VIX to actually spike easily 10, 20, 30% on a single day, just based on the amount of shorts that's been building up within the market. Another thing to take note over here is not only is the complacency sort of fixated in the equity space, over here we have the Treasury VIX, which shows a pretty similar picture to what the equity VIX is showing. So Treasury VIX basically shows you the 10-year Treasury note volatility index, and it's actually hitting a low of 4 in July, surpassing a GFC low of 4.22 extreme complacency level. So over here, same thing, it follows the sine wave downward pattern. Whenever we reach the lower boundary, mean reversion tends to happen. So GFC low was around 4.22, and then subsequently you can see the mean reversion happens. Also in 2012, the Treasury VIX hit a new low at 3.97 due to the amount of QE that's being pumped out into the market, as well as the zero interest rate policy, negative interest rate policy that's been sort of forcing market to buy more and more of the fixed income space, which brought this volatility of the Treasury down to a low of 3.97. But ultimately, taper tantrum happened back in around 2013, and you can see the same thing again once we hit the lower boundary of the extreme low, mean reversion tends to happen. So what we are seeing right now is a similar pattern playing out. Treasury VIX right now hitting the extreme low, suggesting extreme complacency, telling us that we are right now in a late stage economical cycle whereby the mean reversion should more or less follow on in the near future. Some other indicators that we look at to suggest peak optimism as well as late stage economical cycle is sentiment indicator. So for the next three charts, I'll be showing just plainly on sentiment indicators tabulated by the Conference Board Consumer Confidence, the University of Michigan Consumer Sentiment, as well as the Bloomberg Consumer Comfort. So the first sentiment indicator that you are looking at in your screen is the Conference Board Consumer Confidence. What it's showing is that it's been exceeding the pre-crisis high, more so the GFC high of 111. So the recent peak in the Conference Board Consumer Confidence hit a high of 124, and we have been moving in a roaring sentiment all the way back since 2010. But I'd like to point out again, this particular index does actually follow the sine wave downward pattern. whenever it hits both extremes, some kind of a reversion tends to happen. So to point out again, this is the area of .com euphoria that's been building up all the way since 1995, where the conference board consumer confidence spiked above the 112 level. So ultimately, when this particular bubble popped, shown by the extreme optimism that's been built into the market, we saw how badly the market was being affected. S&P fell like 50% during the period, and Nasdaq was the hardest hit of all. So just to watch closely to see what happens within the sentiment space. Like I mentioned, same thing, University of Michigan consumer sentiment, showing a pretty similar picture to the previous chart, taking out pre-crisis high. So the recent high of 98.5 has already exceeded the GFC peak of 96.9. And same thing over here, has been moving up in the steady growing sentiment since 2011. So again, suggesting that we are in a late stage economical cycle as we take up the GFC peak. And last but not least, the Bloomberg Consumer Comfort for the sentiment space. Recent high of 52.8. Same thing again, taking up pre-crisis high. More so the GFC peak of 51. Same thing over here, anything above 51 suggests we are reaching extreme optimism, and we are definitely at the late stage economical cycle of things. Moving on to unemployment rate, you can see over here the sine wave pattern looks even more perfect in the unemployment rate complex. So the unemployment rate has been moving in a steady decline since 2009 from a high of around 10% to the current low of 4.3%. And the 4.3% low that we have seen recently has actually been even lower than the GFC low of 4.4%. And just to take things into comparison, .com low was at 3.8%. So I'm saying is that we are seeing same thing over here, that we are in a late stage economical cycle as we take out the GFC low, and right now heading into where the .com low has been at 3.8%. So if the sine wave kind of a pattern does play out, then chances are we will see a reversal in unemployment rate pretty soon as we are reaching full employment. Another employment indicators that we look at, this is the unemployment claims, basically showing the same picture as the previous chart, suggesting again late stage economical cycle. So this one does provide a better indication of a likely update of the market because it's reported on a weekly basis. So what we have seen is the recent low of 222,000 is the lowest that we have seen since 1973. Comparison-wise, GFC low was 282,000, as well as .com low of 259,000. The most recent low is at 222,000, way surpassed the previous crisis low. So same thing again, like I mentioned, it follows the kind of sine wave pattern over here in the unemployment claims, which means right now we are actually at a ripe stage for a mean reversion to happen for the unemployment claims. And over here we have margin debt to show how much greed has been building up within the market. So the most recent reading of the margin debt is at 550 billion at an all-time high, which is 44% above the GFC peak of 381 billion. You can see the amount of exuberance that has been building up within the market. And history kind of repeats itself over here. So during the .com peak, we saw a high of 279 billion. And subsequently, when .com bubble burst, the margin debt fell along the market down on a 50% magnitude. And you can see since then, comparing peak to peak, the .com peak grew 36% during the GFC peak at 381 billion. And we can sort of pinpoint how the market gets greedier and greedier each time. And you can see a 36% increment peak to peak from .com to GFC. And right now we are seeing an increment of 44%. A lot of exuberance that is building up within the market over here. Same thing again, suggesting we are in the late stage economical cycle. And lastly, we believe this is the canary in the coal mine. So what I show over here is the global junk bond. Again, same thing, suggesting late stage economical cycle, whereby right now we are at an unprecedented high of 2.5 trillion, more than double the GFC peak of 1.05 trillion. So this build up in the high yield junk space basically is a consequence of global QE as well as the zero interest rate and negative interest rate policy that's being set out by the global central banks in the world. And we believe this will not end well, especially when interest rate starts to spike voluntarily or involuntarily. We should believe that that will be the beginning of the default domino will come from the high yield space. So again, over here you can see the amount of greed that has been building up within the market. .com peak was 0.614 trillion, And from that particular peak, it grew 70% higher from this .com peak, whereby a high of 1.05 trillion was reached, which equates to 70% increment of global junk bonds from .com to a GFC peak. So right now we are seeing a bigger, substantial number that's been building up from 1.05 trillion to 2.56 trillion. We believe this is a serious problem that's been building up in the market, and any form of an interest rate spike might actually cause this domino to fall. Which is why we would like to look very heavily into the interest rate related indicator to sort of pinpoint possible market cyclical top in the near future. So here are the indicators that we watch closely to sort of spot identify market cyclical top. So it can be split into 4 different categories, namely interest rate related, which we'll be diving in very deeply into the TED spread and 210 spread. Sentiment-based indicator, like I just shown you, the CB Consumer Confidence, University of Michigan Consumer Sentiment, and Bloomberg Consumer Comfort. Fed-related indicators such as unemployment rate and Fed funds rate, and ultimately diving into price action related and looking into the S&P 500 and how the overall RSI signals market top. And last but not least, the value line geometric to find out a multi-decade triple top that is playing out right now. So in terms of the TED spread space, what it basically means and shows is the TED spread shows the 3-month LIBOR rate minus the 3-month Treasury bill interest rate, and signs of trouble are being highlighted by a rising TED spread. And what I mean by that is when you get a rising TED spread, what is actually happening is you get the 3-month LIBOR rate that's increasing, spiking higher due to the heightened risk that's being built within the interbank market, which cause your banks to sort of require higher interest on the loan that they make, while at the same time a lower 3-month Treasury bill interest rate due to the fact whereby people are bidding into safe haven asset classes such as the 3-month Treasury bill, and thus causing the 3-month Treasury bill interest rate to fall. So the net effect over here is we get a rising TED spread, which usually signifies sort of an increase in panic and credit risk. So some properties that we like to see in the TED spread space to sort of signal this panic is, firstly, we need to see the TED spread spiking above its normal range. And then for point 2, we like to see the TED spread to reach trigger a 1% threshold. And last but not least, the renormalization of the TED spread of the peak to a new low will be the time when the market cyclical top is formed. So get a clearer picture of what I mean over here, we did a case study for the .com period as well as the subprime period. So over here you can see how it actually plays out and how it wants a market top even before the bubble actually popped. So at the top panel over here you have the S&P 500, and the bottom panel you have the TED spread. So like I mentioned, the first thing to look out for is to identify the normal range, which I've highlighted over here in this rectangular box. So during the 1990s period, the upper threshold for the normal range is around 1%. We got the first trigger over here in around third quarter of 1998. And subsequently, like I mentioned, we need to see a second re-trigger of the 1% threshold that happened around in the later part of 1999. And ultimately, the market top will only be formed when we get the TED spread to re-normalize off the spike high to find a new low over here at the normal range. And that actually forms the sort of a .com bubble peak back in 2000. So there's a set of properties that happened in the .com case study, and a similar pattern played out again in the GFC case study, whereby same thing over here. First thing we would like to see is the identification of the normal range. So during the 2004 to 2007 period, the normal range for the upper extreme is around 0.58%. We got our first trigger around in June of 2007, where we got the first spike above the 0.58 normal range. And subsequently, like I mentioned, point number 2 is to watch for the re-trigger of the 1% threshold over here that happened around in July of 2007. And ultimately, for point number 3 to spot the market top, is to watch for the TED spread to re-normalize off its violent spike high to a new low over here, which ultimately formed the S&P 500 DFC top back in around September of 2007, which then led the market to go in a decline for around 54%. So where we are in terms of the TED spread complex, here's the normal range that we've identified going back to 2001. So it's around 0.6%. So ultimately right now, nothing much is ringing loudly in the TED spread space. Recently, we just bounced off a low of 0.14%, and right now test spread is still hovering very safely on the lower side of things at 0.31%. So first thing first, we need to look out for the first warning sign break of the 0.6%, and ultimately for the break of the 1% threshold to signal real panic. And lastly, to watch for the renormalization of the test spread to form a low before the market high is being formed. So just by looking at the test spread space itself, probably even for that to happen, it could easily take another 6 more months to build up before we see a high in the S&P 500. So we'll continue to watch the test spread space closely to see any alarming thing happening within the market. So another interest rate related indicator that we watch closely, which is pretty reliable in terms of signaling recession, is the 2-10 spread. Basically, it's the 10 Treasury yield minus the 2-year Treasury yield. So signs of trouble are being highlighted by a negative 2-10 spread, which basically shows a negative yield curve as well. So over here, we have the 2-10 spread shown in blue. The vertical highlighted regions are the recessionary period. And you can see historically since 1977, whenever the 2-10 spread dips below this horizontal zero line and goes into negative, it pretty much gives us an ample warning of an upcoming recession. And what I mean by that is probably I can run through a few examples over here. So back in 1990s period, around 1999, you can see over here that was when the 2-10 spread actually first dipped below the zero line. And once it started diving lower into negative territory, it provided quite a good warning of a recession that happened later on in 2001. Same thing over here, that was the dot-com crisis period, and same thing in the GFC period. The test spread went negative around in 2005-ish period, and ultimately a recession followed on around the later part of 2007. So you can see over here historically it's been a pretty reliable indicator to sort of a signal of recession. So in terms of the 2-10 spread space, nothing much to note over here because we are still not nearing the zero interest mark. Right now, the 2-10 spread is hovering around 81 basis point. But probably you can see over here, the 2-10 spread has been moving in a steady decline since 2014. And the slope of this particular downtrend is still pretty strong. So we believe that the 2-10 spread is ready to take out the 52-week low of 71 basis point to hit for new lows. But we continue to watch this space for more signs of a negative yield curve. So as of now, both the TED spread and the 2-10 spread aren't really signaling much of a trouble within the equity market. We take a look at sentiment indicators to see how sentiment is doing. So the following three charts will probably show the same thing over here because they measure sentiment. So the first form of sentiment measurement that we like to use is the Conference Board Consumer Confidence, which is reported on a monthly basis. So what it's showing right now is that it's entering into a dot-com euphoria phase, like I just mentioned in the front part of the presentation. So signs of trouble are being highlighted by the break of the long-term uptrend line. And what I mean by that is you can see the lower panel over here shows the CV Consumer Confidence, and top panel over there shows you the S&P 500. So I've marked up this horizontal line over here to show extreme optimism whenever we reach this level of 112. And you can see during the 1990s decade, there's actually a pretty nice uptrend line that can be drawn on the CB Consumer Confidence. And as you can see over here, once sentiment flips around and turns down pretty sharply, shown by this bearish break of this uptrend line in consumer confidence, the market sort of tanked along with it pretty nicely, and that formed the dot-com kick. Same thing over here happened during the GFC period in 2000. So we are able to draw a decent uptrend line from 2003. And as you can see over here, once this particular uptrend line within this consumer confidence actually flipped around, it's sort of a signal the market top in the GFC pick as well. So we believe this time around it will be a pretty much similar replay from the sentiment indicator over here. And we are able to draw a pretty nice uptrend line again back from 2011 point. So around this area is a crucial area to watch. Once consumer confidence starts to flip around and turn into a sharp reversal, there might be a time to be worried about the strength of the US equity market. So as of now, probably some near-term numbers to look at will be this 112 euphoria point. If the CB consumer confidence starts to flip around and drops below 112, that might be the first sign of weakness. And ultimately, once it breaks below this multi-year uptrend line, it probably might signal the end of this particular uptrend and the expansionary phase that we have seen since the start of 2009. Similar picture showing here within the EU MISH consumer sentiment. So I wouldn't go through again in details. So ultimately, you can see the break of the uptrend line basically dictates and confirms the top in the market during this dot-com period, shown by this bearish break, as well as this GFC period of peak suggested by this particular break of this uptrend line within the EU MISH consumer sentiment. So right now, same thing, we are able to draw a pretty nice uptrend line since 2011. And what is needed to flip the sentiment around is for the consumer sentiment to actually drop down and break below this existing uptrend line. And last but not least, the consumer comfort, which provides a more livelier view of the market because it's reported on a weekly basis. Same thing, the break of the multi-year uptrend line, sort of a signal of the top within the market and dot-com period, as well as the GFC period over here. So here we are again able to draw an uptrend line since 2011, and the same analysis applies for the Bloomberg consumer comfort. Is to watch for the consumer comfort to actually reverse around and break below this particular uptrend line to signal some troubles ahead. So ultimately, what we want to see is all three sentiment indicators to turn around at the same time and converge to the downside simultaneously to break below their multi-year uptrend line. So when that confirms itself, when we get the three sentiment indicators confirming the bearish break of the multi-year uptrend line, I think we can more or less call the top within the S&P 500 to have a similar replay of what we have seen during the dot-com as well as the GFC period. But as of now, none of the sentiment indicators are showing that yet. So probably the market might continue to grind higher in the meantime. So unemployment rate is also one of the more reliable indicators that we watch to spot for recession. So what we observe is that signs of trouble are being highlighted when unemployment rate reverses sharply off the extreme low. So like I mentioned again, unemployment rate follows this particular sine wave pattern. And you can see when I zoom it out all the way to around 1940-ish period, you can see the sine wave play out even nicer from the zoom out point of view. So recession tends to follow after the unemployment rate crosses above the 12-month moving average. And what I mean by that is, you can see over here in the chart, the blue line shows the unemployment rate and the red line shows the 12-month moving average. So the vertical line over there shows the recessionary period. And historically, for example, you can see over here back in 2005-ish period, the GFC kind of recession was signaled pretty perfectly when we get the unemployment rate rebounding sharply off its low, and once it crosses above the 12-month moving average, the blue line crossing above the red line over here, it provided an ample time, basically 6 months during that period to signal for the next recession. On average, the lag time for the recession to come into play when we get the crossover trigger is around 8 months or so. So you can see historically it's been pretty accurate in terms of calling for recession once the 12-month moving average trigger is sort of signal. So where we are right now in terms of the unemployment rate complex, most recent reading last Friday, unemployment rate came in at 4.4%, which means the low of 4.3% might very well be the current low, but we continue to watch this. But the key level to watch over here is the 12-month moving average, which right now stands at 4.6%. So more confirmation of a recession will only come into the picture when we get the unemployment rate heading higher above 4.6%, preferably higher than 4.6%, to get a convincing crossover. So in the meantime, we continue to watch this. And we believe this is the most important chart to watch, which basically shows the Fed funds rate. And you can see over here, we like to show is every single time at the end of each rate hike cycle, a recession tends to follow. And what I mean by that is, you can see on your chart, Fed funds rate is being shown in orange line, S&P 500 is shown in the blue line, and you can see every single time when we embark into a rate hike cycle, and when we are nearing the end of it, and when the Fed starts to reduce interest rate or stop hiking interest rate, you can see some sort of a market correction tends to take place. So during this period over here, you can see interest rates spike sharply from around 4% to a high of around 12%. You can see when they stop hiking the interest rate, some sort of a market crash came in. That was the 73, 74 stock market crash. During this period, we saw Latin America debt crisis. Even as early as 90s, we saw the early 90s recession. And probably the two most relatable example that we can draw is the dot-com bubble as well as the subprime period. So probably I'll just go through the subprime example over here. So back in around 2004, the Fed started its rate hike cycle, taking rates up from 1% to a high of 5.25% over a time span of 3 years. So since 2006-2007 period, the Fed stopped their rate hike cycle at 5.25% and kept interest rate flat for the next 1 to 2 years. And their actions actually tell us a lot about the market and how they felt the economy is sort of evolving. When they keep the interest rate flat for a prolonged period of time, it's probably telling us that the Fed probably knew that something is wrong. And ultimately, you can see what happened to the market. When the market started to second guess their action by keeping rates flat for a prolonged period of time during the GFC period since 2006 to 2008, you can see the GFC peak was formed pretty nicely, and the rate hike reduction in September of 2007 actually exacerbated the sell-off. So a pretty similar pattern played out in dot-com period over here. We saw a rate hike cycle that began in 1998, and ultimately once they start to stop their rate hike cycle on this period over here, you can see the dot-com bubble actually flipped around and crashed 46% within the S&P 500. So in terms of the Fed funds rate, the Fed actually began a new rate hike cycle back in 2015 December period, raising rates from 0.25% to 0.5%. And since then, we have actually seen 3 more rate hikes, one in December of 2016 and 2 more this year, March and June of 2017. So we are definitely moving in a new rate hike cycle right now. And the things to look out for within the Fed funds rate space for the Fed to sort of signal some worries is once the Fed funds rates sort of stop its upward trajectory, that might be the time to be wary about the market's movement to the upside. Ultimately is to see whether they are continuing with their tightening rhetoric or not. And once they start to sort of flip side and go into an expansionary phase again, that might be a time to worry about how strong the economy really is. And last but not least, we will just talk briefly on the price action pattern on the S&P 500 to sort of signal some sort of a weakness. So over here, what we have is the RSI on the bottom panel and S&P 500 price action on the top panel. And this is on the monthly time frame. And what we want to point out is when you get an overbought RSI on the monthly time frame, it's actually telling us a lot that the exuberance has been building up very, very steeply. So on the monthly time frame, the RSI hardly exceeds the 70 overbought region unless we are in a euphoria kind of environment. So what I mean by that is you can see during the dot-com era, the overbought RSI was first triggered in 1995, and it's continued to stay above the 70 overbought region for a whopping 57 months before the dot-com bubble sort of picked up. So you can see over here, whenever we hit the extreme high of 70 and above overbought kind of a territory, some sort of a mean reversion were to happen, and this is during the dot-com period where a mean reversion happens once we reach to the upside of 70. Same thing over here during the subprime period. We hit a peak of 79 and a mean reversion happens. But in order to sort of sieve out some noise from the RSI, we sort of place the 10-month moving average to spot possible top. So how we use this signal is when the top signal comes into play, 2 things need to be fulfilled. One is we need to have an overbought RSI to signal irrational exuberance, and at the same time we need to see S&P 500 actually closing below the 10-month moving average, which is the red line. So you can see over here during the dot-com period, this was the point whereby we get that particular top signal, whereby the price is closing below the 10-month moving average, while at the same time the RSI is actually mean reverting off the 70 overbought region. And you can see price action wise, it's sort of a signal perfectly near the top, and since then the dot-com bubble brought the S&P 500 down by 45%. So a similar pattern played out in the GFC period. The RSI first breached above the 70 overbought region back in 2006-ish period, and shortly after, once we get the price closing below the 10-month moving average shown by this particular arrow, together with the mean reversion of the RSI, you can see the GFC prices top was sort of fixated in place, and which brought about 55% decline during that particular correction. So some interesting price action right now is since the start of this year, 2017, the RSI has actually breached above the 70 euphoria period again. And we recently hit a peak of 76. Right now RSI stands at 73, which means we are right now moving in a mean reversion kind of a pattern. So important thing to look out for is for the mean reversion to continue to play out, and for the 10-month moving average to be breached to the downside, which right now stands at 2357. So critical area to watch on the S&P 500 right now will be the 2357 point. Once we get the monthly close below that particular point, together with the mean reversion of the RSI, we might actually be seeing a similar top to the one that we have seen in the .com as well as the GFC peak. And for a further confirmation of the price action, we took a look at the value line geometric, which is also showing weakness of the multi-decade triple top. So why we take a look at this VLG value line geometric is because we believe that the market might be distorted to a certain extent, especially just by looking at the S&P 500, mainly because they are being propped up by a few big boys, whereas the VLG shows maybe a general health and strength of the economy on the stock market, because it represents an equal weighted market cap of 1,675 stocks within different exchanges such as New York Stock Exchange and Amex. So what we actually notice over here is the VLG moves pretty much in line with the S&P 500, and further confirmation of the top within the S&P 500 can be confirmed when we get a bearish break between below the multi-year uptrend line shown by this particular vertical line over here. So this was a .com example. So once we got the bearish break of the multi-year uptrend line within the VLG, it signaled the end of the .com bubble peak as well, and the market crumbled along with it 40% during that period. Similar pattern played out again in 2007 November-ish period, where the uptrend line in the VLG since 2003 actually was reached to the downside. And you can see over here, GFC high was pretty nicely being signaled by the bearish break of this VLG uptrend line. So moving forward, we are right now sort of in a similar pattern here, whereby the VLG is showing an uptrend line since 2009. And for further confirmation of the bearish narrative for the S&P 500 and the general broad-based equity market in the US, I think we'll need to watch for the bearish break below this particular uptrend line in the VLG to signal more confirmation of the bearish sentiment. And before we move on to the last slide, just to point out how nicely this particular multi-decade triple top is forming. So this 509 point seems to be a very critical level in the VLG. It was first sort of established back in 1998 during the .com era, and as you can see over here in the GFC period over here around 2007, this 509 point sort of reacted perfectly again and sort of formed a second top within the GFC peak. Even as early as 2014, 2015 each period, you can see these 509 points play out pretty perfectly again, capping price to the downside. So right now, beginning of this year, the VLG tried to break above this 519 point, but obviously weakness prevailed again. So if this particular 519 point were to sort of stay in place and stay valid, this might actually be a very strong turning point for the VLG to actually turn the VLG down to actually retest and even break below this prior multi-year uptrend line. So keep in mind the price action between the S&P 500 as well as the VLG to spot for further weakness within the market. And hence, in summary, we just tabulated the indicators that we are watching closely in the table form over here. So here's a summary of the indicators that we are watching, as well as the threshold that is needed to sort of signal the bearish sentiment. So right now, none of these indicators are sort of signaling the bearish side of things yet. But like I mentioned again, I'd like to re-emphasize, we are right now reaching the end stage or the near expansionary phase of the current economic expansion. So in the near future, we believe more and more of these indicators will be triggered to the downside or upside to confirm the bearish signal, to sort of confirm the late stage economical cycle that has been suggested by our economical table that I showed in the first slide. And hence, in summary, what we think the US equity market should do in the near future is probably it should continue to grind higher in the meantime until some of the indicators that I've just shown in this particular slide is being breached. So moving forward, probably buy the deep kind of strategy should continue to work for the broad-based US equity market, mainly for the Dow Jones Industrial Average, the S&P 500, and the Nasdaq 100. Yeah, and so with that, we have come to the end of today's webinar. We will pause for Q&A right now, if there is any question. Thank you. Okay, there's a question asking where can we get the data of the indicators that we actually monitor. One website that normal retailers can use is tradingeconomics.com. They provide economical data points on a live update kind of a basis. And then for certain indicators such as TED spread and token spread, probably you can just key into Google. I think there are some websites that tabulate this TED spread and token spread on their website. There's a question asking, is there any correlation between the movement of S&P 500 and STI, or has the correlation been broken? It's quite obvious that the Asian markets still tend to follow the big boy in US, and we believe the correlation isn't broken. So whenever we get major events happening out from US or even Europe and China, you can see local markets in Singapore actually gets affected pretty drastically or in the same fashion as what the US counterparts are doing. So in terms of correlation wise, we don't think that the correlation is broken, especially when you're talking about if crisis were to strike, chances are that everything in terms of equity side of things will face tremendous downside effect when crisis actually happens. There's another question asking when is it likely that the US market turns bearish? In terms of exact time point wise, we can't really confirm yet. But like I mentioned again, is to watch out for all these indicators that I've just put in front of you. So once we start to see any of these indicators start to get triggered, I think that might be the time to be worried about some possible near-term correction. And once more and more of the indicators are being confirmed, there is a very high chance that the market might actually be picking up. And ultimately, again, in terms of the economical cycle, I like to re-emphasize that right now we are in the third longest economic expansion since in history at 98 months. So not saying that it can't take out these 107 months or 190 months, but just to re-emphasize again, we are reaching the end stage of this particular economic expansion. There's a question asking, since there are so many graphs and indicators to follow, can we engage somebody to actually monitor this on a daily basis? Rest assured, we will continue to monitor this on a daily basis, and whenever we get any trigger in terms of the indicators, we will definitely come out with a report to sort of keep you guys up to date in terms of where we are in the economical cycle as well as the threshold that I've just mentioned. In terms of a daily report, I don't think that is necessary because some of the indicators over here, especially sentiment indicator, are being reported on a monthly basis. And being done on a daily basis, we don't really see that as appropriate because all of these things take time to build up and doesn't happen overnight. So chances are that when it happens, we'll definitely keep you guys up to date in terms of the indicator as to where they stand. Okay, someone is asking which indicator is the most crucial one. In my opinion, I believe, again, to bring you guys back to this particular chart first, which is the global junk bond, which the reason why I named this the canary in the coal mine is because the amount of junk debt that's being issued to the market, as well as the amount of moral hazard and adverse selection that has been going through within this space due to the consequence of global QE and negative interest rate, is sort of creating a problem by itself. So this recent high of 5.25 trillion, I believe is the biggest problem of all. And ultimately, what will cause this particular bubble on the high yield space to actually pop for the domino to actually begin is interest rate. So ultimately, I think interest related indicator is the most important one to watch. Basically, again, which boils impact down to CAD spread to show tightness within the interbank level and some uncertainties going within the banks. So ultimately, watch CAD spread, I think, is the most crucial one of all. And things to look out for again for the CAD spread again is I like to re-emphasize the breach above this 1% threshold mark to sort of a signal some sort of a panic within the interbank level. There's a question asking, can the tables be published on a regular basis? I think we can do it, probably if you were to follow our report, we actually have a monthly report that we publish on a monthly basis. So probably we will find a space within the monthly report to place the indicators that I just shown you guys on a monthly basis. And on a subjective basis, whenever any indicators are being triggered, we'll definitely update you guys on a very appropriate timely basis. So question asking why are high yield bonds negatively affected by interest rate movement? So high yields are basically the most sensitive asset class to interest rate, especially when you see a spike in interest rate. So I believe the high yield bonds is the first one to be affected drastically once we see a spike in interest rate, especially on an interbank level. So probably I'll just bring it back to what happened during the GFC period. The main reason why the subprime holders are the one that's being causing all that carnage is because they are the one that's most sensitive to interest rate. And what really happened in the GFC period is when we first get the adjustment of the teaser interest rate up to a normalized range of 3 to 5%, that was when the subprime holders actually realized that they can't afford to pay off their debt. And ultimately, that was the domino that caused the GFC to sort of roll over. So a similar thesis or similar idea is being placed on the high yield space right now. And we believe that high yield is the one that is most susceptible to any spike in the interest rate environment that probably we might be facing pretty soon. There's a question asking if the Fed is not raising interest rate, will it affect junk bonds in the US? Easy way to answer this is be it voluntary or involuntary spike in interest rate, which means be it being induced by the Fed, if they would continue to raise their interest rate or not, believe involuntary spike of interest rate, even from the interbank level, might be strong enough to sort of cause the high yield space to actually crumble. So in terms of where the catalyst is to cause the spike of the interbank interest rate, we can't really see where it is right now. But it's good to note that even without having the Fed raising its interest rate, some sort of an interest rate market-based indicator might actually spike to the upside, might actually cause the high yield space to experience some sort of carnage. So in terms of balance sheet reduction, this month's FOMC meeting will be a pretty crucial one. So I think 20 September is when the Fed is actually meeting and going to announce their FOMC statement. So I think 20 September will be important to see if they hold true to their idea of balance sheet reduction by end of this year. So if that happens, I think we'll see further tightening within the market and to see the language in terms of their rate hike. Following on whether we get one more rate hike this year and the guidance for the rate hike for next year. There's another question asking interest rate wise is because of a better economic performance and better economic performance affect equities positively. True to a certain extent, but then again, there's a lot of other indicators out there that is not really proving that the economy is doing all that well. For example, the recent slump in housing data, uh, as well industrial production, construction spending wise, retail sales. So all in all, there are indicators that point towards a strengthening economy. There are also indicators that are pointing towards weakening economy. What we like to point again is the chart that I'll pull up again in the screen. So every single time, like I mentioned, when the Fed embark on a rate hike cycle, chances are they are actually trying to cool down the market. So what happens is whenever the rate hike cycle ends, when the Fed actually stops hiking its interest rate from its upward trajectory and when the Fed funds rate actually stays flat for a prolonged period of time, I think that is the time to be worried about the strength of the economy. So like I mentioned again, similarly to what happened during dot-com and the subprime period, where I highlighted this area over here, you can see when the Fed actually stopped hiking its interest rate and when they start to go flat with the interest rate, market tops are usually being formed around that period. So this is the dot-com peak that's being set up by the inaction of the Fed, as well as the one in subprime crisis over here. So moving forward, I think this interest rate complex is also another important indicator to watch to see if there is any major change in their language, whether they are still continuing tightening or they are sort of moving towards the easing stance. Yeah, okay, since there are no more questions, we'll end today's webinar here. So thank you guys for tuning in to today's webinar, and we hope to see you again next week. Thank you.